Welcome back to the Deep Dive. Today we are taking on one of the biggest, maybe one of the most ingrained ideas in all of modern finance.
I think you're right. It's almost a piece of folklore at this point.
It really is. We're talking about the S&P 500
Yeah.
and that guaranteed 10% annual return.
Or even 12%. You sometimes hear that one too.
Exactly. It's the number you see everywhere. It's like the foundation for countless retirement calculators. And it's definitely the main driver of investor optimism.
And look, that optimism is a good thing. It's necessary, but it has to be grounded in reality. It has to be tempered with precision.
So the historical numbers aren't totally wrong.
Not at all. Historically, yeah, the S&P 500 total return has hovered right around that 10% nominal growth mark, but only over really long periods.
There's a big but coming.
There's a huge but. That number, all by itself, is fundamentally the wrong one to use for, calculating your own personal wealth, your own trajectory.
So we're not here to be pessimistic about the market.
No, not at all. We're not here to be market pessimists. We're here to be financial realists.
Exactly. The core question is this. If the market gives you that 10% nominal growth, what do you actually keep? What's left in your pocket after those silent killers, inflation and taxes have had their say?
And when you run those numbers, the result is, well, it's startling.
It really is. We found the answer in the research, and that 10% headline average, it just shrinks. For a typical investor in a normal taxable account, it comes down to about 3.6% per year.
3.6.
In real spendable purchasing power. And that gap, the gap between the 10% dream and the 3.6% reality, that's huge.
It's the difference between retiring early and working an extra decade. It's that significant.
So today we're tearing down the myth. We want to reveal the durable, but, far more modest fact underneath.
Our whole goal here is to equip you with accurate expectations. Because really, accurate expectations are the most motivating knowledge you can have as an investor. Well, when you know the real numbers, you stop panicking when volatility hits. You're prepared for it.
Yeah.
And you make better long-term decisions.
This entire deep dive is built on a really phenomenal stack of research that was provided to us by the Insight Vault. It draws on, decades of historical data, analysis of market cycles, and even some cutting-edge financial modeling from advanced institutions like Bayes Business School.
So our mission today is pretty simple, but it's also, I think, pretty profound. We're going to unpack the true mechanics of compounding.
And we're going to dissect all those financial structures that turn the S&P 500's headline number into your actual compounded after-inflation, after-tax real return.
It's a complete look, a full picture of where your money actually goes and what you can realistically and optimistically expect.
Okay, so let's start at the very beginning of all this confusion, that infamous 10 or even 12% figure that gets cited constantly.
Right, it's used to justify everything.
It is. Overly ambitious, safe withdrawal rates in retirement or, those articles about how easy it is to become a millionaire. What is the fundamental, the basic math error people are making when they cite that number?
The error, and it's a really common one, is mixing up the arithmetic average with the geometric average.
Okay, two different kinds of average.
Exactly. When people, especially if they're new to investing, talk about the average return, what they're usually thinking of is the arithmetic average. It's the simplest way to calculate it mathematically. Yeah. You just add up the returns of every single year.
And divide by the number of years. Simple.
Super simple and super misleading.
Okay, so break that down for us. Give us a really simple, maybe an exaggerated example so we can really get our heads around how misleading this can be.
Yeah, absolutely. Let's imagine a really volatile 2-year investment period.
Okay.
In year one, the market just explodes. It goes up 50%.
50%. Wow. So if I started with $100, I now have $150.
Exactly. You're feeling great. But then year 2 happens and the market crashes. It falls by 50%.
Oh. So up 50, down 50, back to where I started, right?
Mm-hmm.
I broke even.
See, that's what your brain wants to think, and that's what the arithmetic average would tell you. Add 50, subtract 50, divide by 2, the average is 0.
It says I broke even. But something about that just doesn't feel right.
It's not right at all, because that second-year loss, that 50% drop, it wasn't applied to your original $100.
Oh, right. It was applied to the 150, the new higher number.
Right. And 50% of $150 is a $75 loss.
So I'm left with $75.
The $75.
Wow. So I actually lost 25% of my starting money, even though the average return was 0.
That is the destructive power of volatility. And that's why, from an investor standpoint, the arithmetic average is Well, it's a meaningless academic curiosity. It is completely irrelevant.
Because it ignores the one thing that actually matters for building wealth.
It ignores compounding. The whole idea of compounding is that your returns, whether they're gains or losses, apply to a changing capital base. If you lose 50% after gaining 50%, that loss hurts more because it's on a bigger number,
So we need to forget the arithmetic average and talk about the only number that really matters for long-term growth.
which is the geometric average. You'll also hear it called the compound annual growth rate, or CAGR.
CEGR. Okay, I've seen that acronym a lot.
It's the important one. The geometric average, the CAGR, is what tells you the constant, steady rate of return you would have needed each year to get from your starting balance to your ending balance, with all the real-world ups and downs smoothed out.
So it's the true measure of your actual growth over time.
It's the true measure of compounding growth, yes. And here's the key takeaway. The CAGR is always lower than the arithmetic average if there is any volatility at all. Always.
Okay, so when you filter out that misleading noise and you look at the real historical geometric nominal total returns for the S&P 500, what's the hard data-backed figure we should actually be using as our starting point?
The historical number is remarkably stable, and it's right around 10%.
So the 10% number isn't a total myth.
It's not a myth, it's just misused. Since 1957, which is when the S&P 500 took its current form with 500 stocks, that KGR has been about 10.39%.
And that holds up over longer periods, too.
It does. Even if you look back over a century, the KGR reliably hovers very close to 10% over any extended period. So that's our first real anchor point for planning. Use 10% nominal CAGR, not the higher, misleading arithmetic numbers that get thrown around.
All right. But even that 10% CAGR needs, as you said, a giant asterisk next to it. Because investors absolutely have to know what that index is actually tracking.
Yes.
This brings us to the difference between price return and total return. And I honestly think this one trips up more people than the compounding math does.
I think you're right. It's probably the most fundamental error a new investor can make.
So what's the distinction?
You have to distinguish between the price return index, which is the one you see on the news every night.
The ticker, SPX, going up or down.
Exactly. That only tracks capital appreciation. It's just the change in the index level. But then you have the total return index.
What does that include?
That captures the capital appreciation plus the automatic reinvestment of all dividends and cash payouts from the companies in the index.
So I see people watching the market news and they see the S&P is up, 1%, and they think that's their growth for the day. Why is that approach, and I'm quoting one of our sources here, beyond worthless?
It's a strong phrase, but it's accurate. It's because they are completely ignoring the massive, massive contribution of dividends over time.
They're just leaving money on the table.
A huge pile of money. Especially if you look back in the 20th century, dividends made up a huge portion of the total return, sometimes well over half of it. Now, that's shifted a bit with the rise of growth stocks that don't pay dividends, but they still provide immense compounding fuel for your portfolio.
Let's use the specific data point from the research to really drive this home. It uses the SPCR S&P 500 ETF, ticker symbol SPY, which was introduced way back in 1993.
Wait, one of the first ETFs.
What happened if you only focused on the price appreciation of SPY versus what happened if you captured its total return?
The difference is just staggering. It's night and day. Since 1993, the price return of SPY, so just the capital appreciation, was a very respectable 789%.
Which is great. Nobody would complain about it.
Nobody would complain. But if you had taken every single dividend that SPY paid out and reinvested it back into buying more shares of SPY, the total return was nearly 1,400%.
1,400%. That's almost double.
Almost double the wealth accumulation. And that difference comes purely from the magic of reinvesting those cash payouts over time. It's absolutely essential to achieving that 10% nominal CAGR.
So the very first step in getting our expectations right is to acknowledge that the 10% figure we're talking about is the total return geometric average.
Right.
And if you're not reinvesting your dividends, if you're taking them as cash, you are automatically underperforming that historical average by a massive margin.
Precisely. And while that total return geometric average is a robust long-term number, the actual return and investor experience is still highly, highly dependent on when they put their money in and when they take it out.
And this brings us to the concept of sequence of returns.
Yes. The order in which your gains and losses occur. It matters a lot.
This is where volatility, which is, just part of the deal with the S&P 500,
Yeah,
becomes a real source of risk, especially for people who are getting closer to retirement.
absolutely. The source material really emphasizes that while the long-term average is strong, timing is everything. Meaning the investor who, say, dumps their entire life savings into the market right at the absolute peak of a bull run.
Like in late 1999 or late 2007.
Perfect examples.
Hmm.
That person is going to experience years of negative or flat returns while the average slowly catches up to them. They'll be underwater for a long time.
And on the flip side, someone who retires or starts drawing down their portfolio during a deep recession, that can do massive damage to how long their money lasts.
It's devastating. Look, if the market goes up 10% a year for 20 years in a straight line, it doesn't matter when you got in. But that's not how it works.
No. For an investor just starting out, or even where someone's starting to withdraw money, the order matters intensely. If the big losses come early in your retirement, you're selling assets at low prices to live, and you have less capital left to benefit from the eventual recovery.
And that sequence risk is exactly why trying to time the market, trying to predict these peaks and troughs, is generally considered malpractice for most investors.
Especially for beginners.
Especially for them, yeah. It's just too easy to get it wrong. And you risk missing the biggest growth days, which, funny enough, are often clustered right around the days with the deepest lows. The market snaps back fast.
So, since we can't reliably time the market, what's the best behavioral guardrail against this sequence of returns risk, according to the research?
The standard, highly effective, data-backed alternative is something called dollar cost averaging, or DCA.
Just investing on a schedule, basically.
Exactly. The mechanical simplicity of DCA is its brilliance. You just invest a fixed amount of money at regular intervals, say every 2 weeks when you get paid, and you do it religiously, whether the market is soaring or whether it's plunging.
By doing that, you're automatically buying fewer shares when prices are high and expensive.
And crucially, you're buying more shares when prices are low and everything's on sale.
So it smooths out your average cost over time.
Mm-hmm.
And it prevents that catastrophic scenario of investing all your capital right at the market peak.
It completely prevents it. It turns volatility from this terrifying short-term risk into a long-term advantage for you. By automating your contributions, DCA helps ensure you actually capture that long-term geometric return because it neutralizes that emotional urge to panic or to chase a hot rally.
It's a key strategy, then, for making sure your personal return doesn't fall way below the index's return.
It's probably the most important one.
Okay, we have our target. It's the 10% nominal CAGR, total return. Now let's talk about reality, because the moment we introduce inflation, that 10% figure becomes, well, pretty meaningless in terms of what you can actually buy with it.
This is the first great reducer.
And it's the great deception of the stock market, isn't it?
It really is. You feel great, you gain 10% in dollars. But if inflation is 3 or 4 or even 5% that year, then your actual buying power hasn't gone up by 10% at all.
Your money buys less stuff. A 10% gain might not even keep you ahead.
Exactly. The numbers we use for planning, for our own goals, must always be the real return.
What's left after inflation takes its bite?
Right. So historically, what does that 10% nominal return shrink to once we adjust for inflation?
The drop is significant. Historically, the real annual return drops. The average S&P 500 returned to somewhere between 6 and 7%.
So a pretty big haircut right off the top.
A huge one. The data provided is quite precise on this. Since 1957, the real return has been about 6.68%. And if you stretch it all the way back to 1928, which covers the Great Depression, World War II, decades of high inflation.
All the scary stuff.
All of it. The average real return is still 6.84%. It's a very durable number.
So we've already dropped from our hopeful 10% down to a much more sober, say, 6.8%.
And that 3.2 percentage point difference, that's just the cost of doing business. It's the cost of simply maintaining your purchasing power from year to year.
That is the figure investors should be using as their optimistic benchmark, not 10%.
Absolutely. That 6.5 to 7% real return, that's your new financial anchor for any long-term equity growth planning.
But the research points out an important caveat here, even about that calculation.
Which is?
The inflation adjustment almost always relies on the official consumer price index, the CPI.
And what's the issue with using the CPI?
Well, many analysts argue that the CPI, particularly in recent decades, might be understating the true cost of living increase that regular people experience.
Especially in certain big-ticket categories.
Exactly. Key areas like healthcare, education, housing. The costs there have often risen much faster than the official CPI number would suggest.
So if the CPI is understating inflation, then the true real return and investor experiences might be even a little bit lower than that 6.8%.
It could be. It just emphasizes the need to be conservative when you're modeling your financial future. Maybe you model for 6% just to be safe.
Okay, so if 6.8% is the best case, what happens when the second great reducer, taxes, comes into play?
Ah, yes. The big one.
This is where the difference between your tax-advantaged accounts and your regular old brokerage account just makes or breaks your long-term success.
Taxes are the portfolio killer. They are a massive, massive drag on compounding.
Why are they so damaging?
Because they're taken out at every stage. They can be taken off the top of your compounding principal, they're applied annually to any dividends you receive, or they're levied as capital gains at the very end when you sell. There's no escaping them in a taxable account.
The research provided a really excellent analysis on this. It looked at rolling 10-year periods all the way back to 1950, and it tracked the market's performance under 3 completely distinct tax structures.
And the results are, well, they're eye-opening.
Let's break down those 3 scenarios, because the results really demonstrate why the type of account you save in matters more than almost anything else.
Okay, so let's start with the best possible scenario for long-term growth. This would be a tax-free account.
Like a Roth IRA or a Roth 401k.
Exactly. The key here is that the money gets taxed before it goes into the account. You pay your taxes up front.
And that means?
It means every single bit of compounding, the dividends, the capital appreciation, all of it grows and is eventually withdrawn completely 100% tax-free.
So what was the average real return for an investor in that perfect scenario?
In this scenario, the investor captured the full theoretical maximum. They got 6.8% per year real return.
The whole thing.
The whole thing. This is the highest figure an investor can possibly achieve. You're using the full power of compounding with zero tax interference. The only drag you suffer is the unavoidable one of inflation. This is your gold standard.
Okay, gold standard is 6.8%. Now, let's move to the most common American retirement account, the tax-deferred account.
Right, your standard traditional 401k or IRA.
With these, you get the tax deduction now when you contribute, but that tax bill is coming due later.
It's waiting for you. It comes due upon withdrawal in retirement. So assuming a modest but realistic 22% marginal income tax rate when you finally take the money out, the numbers change.
And how much does that future tax liability cost you?
The average real return per year drops pretty notably down to 5.2%.
From 6.8 down to 5.2.
Yeah. Think about that for a second. Simply having that eventual 22% tax bill hanging over your portfolio costs you 1.6 percentage points of real annual growth compared to the Roth.
And that 1.6% compounds away from you over decades.
It's a huge amount of lost growth over a lifetime.
So 5.2% real return. That's the realistic benchmark for most people saving diligently in their employer-sponsored plans.
I think that's a very solid number to plan around.
But now we hit the most common scenario for people who max out those retirement accounts and want to keep saving, the standard taxable brokerage account.
And this is where the dream of 10% really crashes hard into reality.
Because in a taxable account, you're facing a triple threat from taxes.
That's a good way to put it. First, you pay income tax on the principal before you even invest it. Then you pay taxes on any distributed dividends every single year, whether you reinvest them or not. And finally, you pay capital gains tax when you sell your shares.
It's death by 1,000 cuts. And the result?
The average real return per year just plummets. It goes all the way down to a mere 3.6%.
3.6.
Wow. The source material really emphasized the total impact. In nominal terms, over a 10-year period, taxes decrease the total compounded returns by roughly 41%.
41% just
Gone. What would have compounded to, say, 170% growth in a tax-free Roth account only grew to 100% in the taxable account. Almost half the growth was eaten by taxes.
We should really pause here, because this, to me, is the crucial finding of this whole deep dive. We started with this fantasy of 10%. Now we know that for someone saving aggressively outside of their tax-advantaged accounts, the real spendable growth rate is likely to be 3.6%.
That number changes everything.
It fundamentally changes how you model your retirement, how much you need to save, how long you need to work, everything.
It does, and it just reinforces that absolute guiding principle of personal finance. You maximize your tax-advantaged accounts first. The 401k, the IRA, the HSA, fill those buckets first.
Because the difference between 6.8% and 3.6% over a 30-year savings horizon it's monumental.
We are talking about hundreds of thousands, or for some people, even millions of dollars in final value. It's that big a deal.
But I want to pivot back to the optimistic side here. Even with that pretty small 3.6% figure, why should an investor still bother with that taxable account, even though the return seems so low compared to the others?
Because the alternative is a guaranteed loss.
You mean holding cash?
Holding cash. The whole point of investing in a taxable account, even for a 3.6% real return, is that it is infinitely better than holding cash in a savings account. The research noted that over the past year, with high inflation, cash held in a bank suffered a real return loss of about -8%.
So you are actively getting poorer by holding cash.
You are guaranteed to lose purchasing power if you keep your money in cash. By contrast, a 3.6% real return, even after all the taxes and inflation, means you are actively building wealth. You're preserving your capital and then some.
That provides really critical context. We're investing to beat the drag of inflation, and 3.6% absolutely does that, even if it's a far cry from the headline 10%.
Exactly. So we've covered the mechanical and the structural drags, volatility, inflation, explicit taxes, but there's one final critical factor that reduces an investor's realized return.
And this one is purely internal.
This one is all on us. It's the behavioral drag.
The human element. The one thing we can theoretically control, but so rarely do. This is where investors consistently manage to underperform the very index they're invested in.
Consistently. It's almost comical if it weren't so tragic. Study after study has shown that the average investor underperforms the index by a significant margin,
How much are we talking about?
often falling short by 2 to 5% per year.
That is a staggering amount of self-sabotage. Why?
Yeah.
Is it bad luck, bad stocks?
No, not at all. It's driven entirely by emotional mistakes.
Such as?
Panic selling during a sharp market correction. You're driven by fear, you see red on the screen, and you just want the pain to stop, so you sell.
Selling at the bottom.
The absolute worst thing you can do, and the flip side is just as bad, FOMO buying. Fear of missing out.
Chasing a hot market at the peak.
Right. Greed takes over. You see everyone else getting rich and you think, I have to get in now before it's too late. So the average investor often sells low and buys high, which is the exact polar opposite of what long-term investing requires.
Let's put a number on that. If we take our average investor in the tax-deferred 401k, they were targeting a 5.2% real return.
Right.
If their own behavioral drag costs them, say, 2.5%, the midpoint of that observed range, they are now down to a 2.7% real growth rate.
That's horrifying.
It is. After all that work, all that saving, they're barely beating inflation because of their own emotions.
And this is precisely why realistic expectations are the strongest form of behavioral defense you can have.
Explain that.
Well, if you go in expecting 10%, a 20% market drop feels like an absolute catastrophe. It feels like the system is broken, and you're much more likely to sell out of frustration or fear.
But if you know the real numbers,
If you enter the market knowing the real long-term expectation is somewhere in that 5 to 7% real return range, you understand that those sharp drops are just the price of admission. They are the volatility you have to endure to capture that long-term average. It reframes the whole experience.
so discipline and patience aren't just, abstract virtues your grandpa told you about. They are quantifiable sources of return.
That's a great way to say it. If you can simply avoid the behavioral drag, if you can just stay in your seat, you literally add 2 or 3 percentage points back to your final compounded wealth.
And that's the most empowering realization of all, isn't it?
It is. You have direct control over a major portion of your final return just by controlling your own emotions and sticking to a consistent plan like dollar cost averaging.
Realistic expectations lead to enduring outcomes.
That's the bottom line.
Okay, before we move on to the really fascinating forward-looking forecasts, we need to ground ourselves in a little more historical context and look at the structure of the market as it exists today. We keep talking about this 10% long-term average, but that average contains within it some wild, dramatic cycles. And understanding those cycles is crucial for maintaining that discipline we were just talking about.
The volatility is what produces the average. You can't have a 10% average without the scary 40% drops. They're two sides of the same coin.
And the classic, most recent example is, of course, the 2008 financial crisis.
Oh, yeah. The S&P 500 just plummeted, a devastating 46.13% from its peak in October 2007 to its low in March of 2009.
Nearly cut in half. That's enough to bankrupt anyone who panics and sells during that window.
Absolutely. But the source material also makes a point to note the immediate aftermath of that crash.
Which was?
That decline was followed by the longest bull run in modern history. The market rose 330% over the next decade.
The lesson there is pretty simple, but it's critical for that discipline we keep talking about.
It is. Every single major historical decline in the S&P 500 has been followed by an eventual recovery and a new all-time high. The market is incredibly resilient. The only variable is the time frame, which can sometimes be frustratingly long.
Right. But historical averages also carry a serious risk of misleading us about the immediate future.
How do you mean?
Well, just because the market historically returned 10% doesn't mean it's going to do that over the next 10 years. Particularly, we're starting from a very high base.
Ah, yes. This is a critical nuance. This brings us to the relationship between the starting price-to-earnings ratio, or PE ratio, and what happens next.
So the PE ratio is just a simple valuation metric, right?
Yeah.
The price of the index divided by the earnings of the companies in it.
Exactly. When the PE ratio is high, it means stocks are expensive relative to their underlying profitability. When it's low, they're cheap.
And what does the research show about starting expensive versus starting cheap?
The data, especially when you look at rolling 20-year periods, shows a very, very strong inverse correlation.
So they move in opposite directions.
Exactly. When investors bought into the market at a historically high starting PE ratio, their subsequent 20-year returns were significantly lower than the historical average. And conversely, investing when the PE ratio was low, when stocks were cheap and out of favor, often preceded periods of extremely high subsequent returns.
So the high historical 10% CAGR is an average that benefits from including periods that started dirt cheap, like the 1970s or the early 1980s.
Correct. We can't just assume that that average will magically materialize if current valuations are stretched far beyond their historical norms.
Forward returns are conditional on present valuations.
Perfectly said. And that brings us to the structure of the market itself, which is introducing some structural risks that feel quite new to a lot of modern investors, namely concentration risk.
The S&P 500 is supposed to be this paragon of diversification, right?
Yeah.
500 of the biggest companies across the entire U.S. economy.
That's the theory.
But the research shows the weighting inside that index has shifted dramatically. It's moved away from, say, manufacturing and industry and towards a single dominant sector.
The change is monumental. If you go back to 1957, industrials made up over 40% of the index. Today, the technology sector alone exceeds 25% of the market cap.
And the real structural danger isn't just the sector itself, it's the concentration within that sector.
That's the real story.
We're talking, of course, about the Magnificent Seven.
Indeed. As of May 2025, just 7 companies, Alphabet, Apple, Amazon, Meta, Microsoft, NVIDIA, and Tesla, accounted for a staggering 33.5% of the entire S&P 500's market value.
Let that sink in. 1/3 of the value of the supposedly diversified U.S. stock market is reliant on the performance and, the regulatory health of just 7 ticker symbols.
It's incredible. It means that if those 7 stocks, for whatever reason, a major regulatory overhaul, an internal competitive shock, a sector-wide correction, if they stumble at the same time,
Then the other 493 stocks would have to perform exceptionally well just to keep the index flat for the year.
that's the definition of concentration risk. We saw a stark illustration of this in 2024.
With NVIDIA.
With NVIDIA. The company alone accounted for almost a quarter, 23% of the S&P 500's entire market capitalization growth.
So if you missed the boat on NVIDIA, you dramatically underperformed the index, even if you owned all the other 499 stocks.
That's right. Your diversified investment was really a bet on one company.
You mentioned that this level's concentration is historically high. What benchmarks are we using to compare today's market structure to?
The historical parallels are a little concerning. The source material notes that the last time the single top stock was so much larger than the 75th percentile stock was all the way back in 1932.
During the deepest point of the Great Depression.
Right. And what's more, the overall market cap concentration today is higher than it was even at the peak of the 2000 dot-com bubble.
So we've got a situation where our historical average return is based on a much more diversified economic representation. But the current structure suggests our future performance is highly contingent on the continued success of just a handful of massive tech companies.
That's the risk.
So how should investors process that risk? What does it mean for them?
It means the volatility inherent in the S&P 500 is now disproportionately tied to idiosyncratic risks that are specific to these 7 firms.
Not the economy as a whole.
Right. If one or two of those firms face a major internal crisis or a regulatory setback, the downside drag on the overall index will be immense. It magnifies that short-term sequence risk for anyone retiring or selling.
It really begs the question, which I know we'll come back to in the outro. Is relying solely on the S&P 500 still adequate diversification in this highly concentrated environment?
It's the question every long-term investor should be asking themselves right now.
Okay, we've established the real historical return, that 6.8% real tax-free number. And we've established the reality of concentration risk. History is illuminating, but investors really care about the future.
Right. What's going to happen next?
Exactly. So now we enter the most sophisticated part of our deep dive. How do expert financial models forecast expected returns right now? Not based on what happened decades ago, but based on current market behavior.
This is where we move from looking backward to looking forward. And the central concept we need to understand is the equity risk premium, or ERP.
Equity risk premium. Okay, what is that in simple terms?
Simply put, the ERP is the extra reward. It's the expected excess return that investors demand from a stock index for taking on risk.
Compared to what?
Compared to holding a risk-free asset like a U.S. Treasury bond, it's the extra juice you expect to get for taking the risk of owning stocks.
And that expectation of return should vary, right? It should depend on how risky the market feels at any given moment.
Absolutely. The ERP is not a fixed number. It has substantial variation based on the time horizon, economic conditions, volatility, all of it.
And what's the most accurate, real-time way to observe what investors actually expect to happen?
We look at options data. We look at the contracts that allow people to bet on or to insure against future market movements. The options market is where expectations are priced in real time.
Okay, let's try to unpack the core math here, but we need to keep this grounded. We're moving into some pretty advanced concepts now, like PQ duality. And for a lot of listeners, that probably sounds like a foreign language.
It can, yeah.
Can you explain what these two distributions, P and Q, represent? Maybe using a simple analogy.
I will do my best to translate the quantitative finance into plain English. We're basically dealing with 2 different views of probability.
Okay.
First, we have the Q distribution. You can also call it the risk-neutral distribution. Think of this as the market's internal mechanical pricing. If the market were inhabited by robots that felt no fear and no greed, this is how they would price the probability of the S&P 500 reaching certain levels in the future.
So Q is the purely mechanical, objective price tag on risk, inferred directly from option prices.
Perfectly put. It's what the market prices the risk at.
Yeah.
But then you have the P distribution, the real-world distribution.
Is it?
P is the statistical probability distribution that we as actual human beings who experience fear actually expect for future returns. P is what we should use for our retirement planning.
So the crucial insight here is that P is not equal to Q.
They are never equal.
And why not? Why aren't they the same?
Because of human emotion. People are risk-averse. We demand to be compensated for taking on fear and uncertainty.
Give me an example.
Okay, if I offer you a simple coin flip, heads you win $10, tails you lose $10. A risk-neutral robot, the Q distribution, says that's a perfectly fair bet with an expected value of 0.
But a human.
A human says no thanks. Because the pain of losing $10 feels worse than the pleasure of gaining $10 feels good.
So to get me to take that bet, you'd have to sweeten the deal.
Exactly. I'd have to offer you a chance to win $12 or maybe $15 to risk losing that 10. That difference, that human demand for extra compensation for risk, that is the link between Q and P.
And how does the math actually connect these two concepts? How do we quantify that human fear factor?
We use a surprisingly simple and elegant mechanism. It's called the exponential tilt, or sometimes the Escher transform.
And what does it do?
It's a mathematical operation that systematically adjusts the Q distribution, the market's objective price, into the P distribution, the real-world probability. And it does this by applying a single crucial parameter.
And that parameter is gamma, the Greek letter gay.
Yes. Gamma, or GAY, is the mathematical measure of how risk-averse investors are perceived to be.
So it's our fear thermometer.
That's the perfect way to put it. It's formally known as the coefficient of relative risk aversion, or CRRA. The higher the gamma value, the more risk-averse the market is.
Meaning investors are demanding a much higher expected return in the real world, P, for the same level of objective risk priced by the market, Q.
Exactly. So if the market gets terrified, gamma goes up, and the mathematically expected returns must also go up to compensate those terrified investors for continuing to hold stocks.
So how do we actually estimate what this gamma number is? It must be tricky given that emotions change day to day.
Well, historically, analysts used pretty simple long-term methods. They'd look at decades of daily and monthly stock returns, going all the way back to the 1920s, and from that data, they'd estimate that gamma is plausibly between 2 and 4.
A pretty consistent historical range for human risk aversion.
Very consistent. But the more sophisticated models that use options data can give us a much more precise, real-time estimate.
You're talking about the maximum likelihood estimate.
I am. The maximum likelihood estimate, or MLE, is a statistical technique that basically finds the single most probable value for gamma that best fits all the observed market data. In this case, they used 11 years of monthly returns, and the study found the MLE for gamma was 4.5.
So 4.5. Why is that interesting compared to the historical 2 to 4 range?
It suggests that in the modern market period, maybe due to increased globalization or complexity or just higher volatility, investors might be slightly more risk-averse. They might be demanding a slightly greater premium for holding equities than they did in the past.
So the confidence in that number is pretty high.
Well, the analysis provided a wide 95% confidence interval for the true gamma value, ranging from 0.84 up to 8.11. This just accounts for the uncertainty and acknowledges that human behavior is complex, but it confines the true measure of risk aversion to a specific, statistically robust band.
Okay, but the key takeaway here, the ultimate conclusion of all this high-level math.
Yeah.
Why is this gamma-tilted Q distribution better than just using historical returns or the market's current price structure to forecast the future?
Because the research firmly rejected those simpler hypotheses. They proved with 95% confidence that the true real-world probability, P, is not just the market price probability, Q, and it's also not just the long-run historical average.
So the best forecast is the one that combines the two.
The gamma-tilted Q distribution is the best systematic forecast of the real-world probability because it explicitly integrates that human factor, our risk aversion, into the math that's derived from current market pricing.
It's the synthesis of the objective market price and the subjective human fear.
Yes, and this synthesis leads to a really fundamental relationship. The expected return is mathematically tied to the expected volatility.
It connects all the dots.
It connects them perfectly. The generalized Mertens relationship states that the expected risk premium, the ERP, is linearly related to the variance or risk of the P distribution. The formula is ERP equals AAF.
Okay, in simple terms.
In simple terms, given our quantified measure of human fear, which is gamma, the higher the market's expected volatility, or sigma squared, the higher the expected return, or ERP, must be to keep investors in the game.
Risk requires compensation. More risk requires more compensation.
That's the fundamental law.
This sounds theoretical, but we can actually see this relationship playing out dramatically during moments of real market stress. It provides real-world proof of how investor emotion gets quantified.
Absolutely.
Let's look at the COVID-19 timeline examples provided in the research.
The COVID period was a perfect stress test for these models. Let's take March 3rd, 2020. The market was incredibly volatile.
What happened that day?
Well, the S&P 500 initially rallied 4.6% because everyone was anticipating an emergency interest rate cut from the Federal Reserve. But then, when the cut actually happened, the
Volatility in that reversal.
market suddenly realized that the situation must be much worse than anyone anticipated if the Fed had to resort to such a drastic emergency cut. Panic set in.
And the models kicked this up.
Instantly. In that immediate short-term aftermath, investors' perceived risk just skyrocketed. Our model showed the short-term ERP spiking to over 110% annualized.
Wow.
The market was demanding an incredible short-term return to compensate for that sudden, immense fear and uncertainty.
That's the math, literally quantifying panic. Now, let's fast forward just 9 days to March 12, 2020. This was the moment of peak fear.
This was when the market circuit breakers were triggering, trading was halting, and the 10-year Treasury yield, the risk-free rate, hit a record low of 0.5%.
The financial system was screaming.
It was. And in that moment of maximum short-term uncertainty, the short-term ERP spiked dramatically higher. It reached over 500% annualized.
To 500%. And to be clear, that's not a prediction that the market will go up 500%.
No, God, no. It was the market's demand for compensation. It was an indication of an enormous, immediate, short-term risk expectation. The market was telling you in real time just how scared investors were and how high the expected returns needed to be to incentivize anyone to hold stocks over the next 30 days.
And it's incredible that this complex math can be estimated almost instantaneously.
That's where modern finance really shines. These complex ERP term structures, these dynamic forward-looking forecasts. They can be estimated almost instantly using technology derived from the VIX, the so-called fear index, and other replication formulas.
So there's no complex, time-consuming optimization needed.
Nope. It provides a real-time, robust estimate of where the market expects to go, all anchored by that steady, measurable human factor, gamma.
It really brings us full circle. We've moved from a simple, misleading 10% average to a precise, reality-adjusted real return, and now, finally, to a forward-looking forecast model that quantifies human emotion to project future return expectations.
The disciplined investor now has the tools to understand both their historical trajectory and their immediate expectations.
This deep dive, which was powered by the research from the Insight Vault, has taken us from that superficial 10% myth all the way down to the hard numbers that really define long-term investing success.
And I think the key here is to understand that true optimism doesn't come from high, unrealistic goals. It comes from durable, achievable precision.
Absolutely. We have replaced the vague hope of 10% with a conservative, fact-based action plan.
You can be, and you should be, profoundly optimistic about the power of equity compounding over time, but you have to factor in those great reducers.
Okay, let's solidify those key, practical, long-term expectations for the disciplined investor listening right now. What are the conservative real growth figures we should be using for our future planning?
Okay, let's run it down. You start with the nominal CGR of 10% as your historical benchmark for the S&P 500 total return. Then you adjust for reality.
Scenario 1. The best case.
For money held in your tax-free accounts, like a Roth IRA or Roth 401k, you should plan conservatively for a real annual growth of about 6 to 7%. This is your best-case scenario where the only drag is inflation.
Okay, now the most common case.
For money in your tax-deferred accounts, your traditional 401k or IRA, plan for about 5% real annual growth. That factors in that eventual future tax bill you have to pay.
And finally, for money saved beyond that.
And for money held in a standard taxable brokerage account, you need to be more conservative. Plan for something closer to 3 to 4% real annual growth. You have to recognize the profound drag of capital gains and dividend taxation.
And through all of this, the most important lever an investor can pull remains behavioral.
It's the easiest lever to describe and the hardest one to actually pull. Patience and discipline
Things like the systematic, unemotional process of dollar cost averaging.
are empirically proven to be more effective than attempting market timing. Avoiding that behavioral drag, that self-inflicted 2 to 5% loss, is the single greatest thing you can do to ensure you actually capture the real return the index offers you.
Finally, we covered those incredible insights from the financial modeling, that the best systematic forecast of what the market will do next is derived from current option pricing.
Meticulously adjusted by that inherent human factor of risk aversion, gamma, we can literally quantify the collective fear and greed of the market.
And knowing the volatility and knowing the human expectation of risk allows us to set intelligent, forward-looking strategy.
That's the goal.
All right, now, here is the final provocative thought we promised to leave you with, based on the findings of this deep dive.
Okay.
Given the extreme, historically high concentration risk we discussed, the Magnificent Seven accounting for 1/3 of the entire S&P 500's market value, should a long-term investor still rely solely on the S&P 500 for diversification?
Or does this high concentration necessitate actively expanding your portfolio? Should you be looking to international markets or emerging markets or broad global indexes to mitigate the specific idiosyncratic risk tied to just 7 enormous technology companies dominating the main U.S. index?
It's a crucial question, really, about the very definition of diversification in our current financial era.
It is.
Something for you to ponder as you adjust your own expectations from that misleading 10% to your true, durable, real rate of return.
Thank you for joining us for this financial reality check.
And our profound gratitude once again to the Insight Vault for providing the detailed, high-caliber research materials that made this extensive deep dive possible. We'll catch you on the next one.